Hi, I'm Daryl Hart, a blogger who loves talking about financial gossip. So, what's the hottest, most explosive news in the markets right now? Nope, it's not the S&P 500 hitting new highs. And it's not the Fed debating whether to cut rates. It's this Warren Buffett just made a big move. Some people say watching Buffett's portfolio is like sneaking a peek at the exam answers for the future. Because when he buys or sells something, it's usually a reflection of how he sees the world playing out over the next few years. And this time, his latest 13F filing sent the whole market buzzing. On one hand, he's slashing Apple and Bank of America. On the other, he dumped T-Mobile completely. At the same time, he's adding to United Health and real estate-related stocks. Oh, and here's the kicker. Buffett is now sitting on a record $344 billion in cash. That's the biggest cash pile he's ever had. You could say it's like stocking up on food before going into battle. But hey, let's slow down and unpack this. You might be asking, wait, isn't Buffett all about buy great companies and hold forever? Apple was supposed to be his big long-term bet, right? And hasn't he always liked bank stocks too? So why is he suddenly trimming them down? And on the flip side, why is he bold enough to buy into healthcare and real estate right now, sectors that have been under pressure? If you connect all these moves together, you'll see they actually reveal Buffett's view of the big picture, especially his read on the Fed and interest rates. Let's start with move number 1, cutting Apple and the banks. Apple needs no introduction. It's been Buffett's anchor stock for the past decade. At one point, Apple made up more than 40% of Berkshire's portfolio. Basically, Apple's performance decided Buffett's performance. But now he's been trimming it quarter after quarter. The size of the cuts shocked Wall Street. People joked, did Buffett lose faith in Tim Cook? Or did Apple suddenly go bad? The truth is simple. Apple's still a great company, but the stock is just too expensive. Think about it. Apple's trading at around 30 times earnings. That's rich for a value guy like Buffett. His logic? Instead of clinging to a high-price stock, why not lock in the gains and move money into assets that are cheaper and have more upside? It's like building a skyscraper. No matter how strong the foundation is, if you keep stacking floors higher and higher, eventually it gets risky. Now, Bank of America. Why cut that one? Even more straightforward. Over the last 2 years, the Fed hiked rates to their highest in 20 years. Sure, that boosted banks' interest income on paper, but here's the catch. High rates killed loan demand, and default risks are climbing. Imagine you had a mortgage that used to cost $3,000 a month, now it's $5,000. That's a huge strain. Naturally, fewer people are borrowing. And on top of that, U.S. economic data has been disappointing. Job numbers revised down massively, warning signs everywhere. That's a recipe for higher bad loans. Buffett cutting banks is just him sidestepping the risk. So yeah, it looks like letting go of his favorites, but really it's survival mode. It's like a basketball coach pulling his star player when he's out of form. Doesn't matter if he's the MVP, you've got to think long-term about winning the season, not just one game. Move number 2, buying United Health. At first glance, this confused a lot of people. Healthcare stocks have been beaten up this year. Costs rising, margins shrinking, lots of companies bleeding. So why buy now? And why United Health, the giant? Here's where Buffett's classic playbook comes in: buy when everyone else is scared. Picture this: you're at the grocery store. Normally, a ribeye steak costs $20 a pound, and you think, too expensive. Then one day, it's on sale for $12. What do? You grab a couple extra packs and stick them in the freezer. United Health is that ribeye steak on sale. And let's not forget, America runs on healthcare. With an aging population, demand for insurance is only going up. Sure, in the short term, profits look messy. But in the long run, this sector is as solid as it gets. Buffett isn't betting on next quarter, he's betting on the next 10 or 20 years. This reminds me of a classic Buffett story. Back in the 1960s, he bought American Express during a scandal. The company was caught up in a huge fraud involving oil storage receipts, and the stock tanked. But Buffett did his homework. He realized the brand and core business were still intact. So he bought big. A few years later, it was a massive winner. Buying United Health now is kind of like American Express 2.0. Everyone's scared, Buffett isn't. Now, move number 3, real estate, steel, and the rate cut play. At first, this sounds boring, right? Real estate and steel? Come on. Real estate has been crushed because mortgage rates are above 7%, pricing out a lot of home buyers. But this is exactly where Buffett starts buying homebuilders like D.R. Horton and Lennar. It's the ultimate contrarian move. Think of it like digging a well in a drought. Everyone else says, there's no water. But Buffett knows the rain is coming, and when it does, that well will overflow. So why does he think the rain's coming? Simple, he's betting on Fed rate cuts. The US economy is showing cracks. Jobs being revised down, manufacturing contracting, consumer spending stretched thin. Inflation has cooled but still sits above target. Add it all up, and chances are the Fed starts cutting rates soon, maybe even as early as September. Rate cuts change the whole game. Lower mortgage rates unleash pent-up housing demand. It's like a compressed spring finally snapping back. Builders, construction suppliers, furniture companies, they all benefit. Steel fits the same story. On the surface, it looks like a dying industry. But Buffett sees it differently. With reshoring of manufacturing and big infrastructure spending in the US, steel demand could bounce back. It's the foundation of everything: houses, bridges, cars. By buying steel now, Buffett's basically stocking up on raw materials before the building boom. And then there's Chevron, his big energy bet. While everyone's chasing solar, EVs, and wind, Buffett's sticking with oil and gas. Why? Because the energy transition takes decades. Oil and gas aren't disappearing anytime soon. Meanwhile, they pump cash, pay fat dividends, and hedge against inflation. Owning Chevron is like having an old rental property in a prime location. Even if shiny new apartments are going up around town, your place still pays steady rent. Notice the pattern? Real estate, steel, energy, these are classic rate-sensitive, real economy plays. Buffett's portfolio is basically front-running a rate cut cycle. Think of it like this: picture farmland before the rainy season. The soil is cracked and dry. Farmers are worried nothing will grow. But Buffett? He's already planted seeds. He knows when the rain hits, growth will explode. Rate cuts are that rain. Real estate, steel, energy, they're the crops. Now let's talk cash. Buffett's famous for saying cash is king. And this time, he's hoarding a record $344 billion. Why? Because when markets look frothy, holding cash is like keeping dry powder for battle. Imagine you're a general, you don't know exactly when the enemy will strike. Even if you've got strong troops, you still stockpile supplies. That's Buffett's mindset. Cash isn't just defense, it's offense. When panic hits and stocks drop, Buffett's ready to pounce. While retail investors panic sell, he's waiting to scoop up bargains. He knows fear creates the best buying opportunities. Last but not least, we can't ignore the Buffett succession angle. The man is 93. His successor, Greg Abel, is lined up. You can see Buffett gradually shifting his style from a super concentrated, all-in on Apple approach to a more diversified, theme-based portfolio: healthcare, housing, steel, energy. It's like a veteran gardener who spent decades growing apple trees. But now he's planting oranges, pears, even grapevines. The principle hasn't changed: patience, discipline, value, but the orchard is getting more balanced for the future. So what does this mean for everyday investors like us? We don't need Buffett's billions to learn from him. 1. Look for undervalued assets when fear is high. Just because a stock's beaten down doesn't mean it's broken. 2. Pay attention to rate-sensitive sectors: housing, energy, steel, healthcare. 3. Keep some cash. Don't go all in, wait for your moment. 4. Think in cycles. If rate cuts are coming, position ahead of the crowd. 5. Above all, play the long game. Buffett's looking at decades, not headlines. We should too. To wrap it up, Buffett's latest moves boil down to this: trimming Apple and banks equals locking in profits, reducing risk. Buying United Health equals contrarian bet on long-term healthcare demand. Adding real estate and steel equals playing the rate cut cycle. Holding Chevron equals cash flow, inflation hedge. Hoarding $344 billion cash equals defense plus offense, waiting for the big play. Evolving strategy equals preparing Berkshire for the post-Buffett era. For regular investors, this is basically an investing masterclass. Stay disciplined, hold cash, buy when others panic, focus on real economic cycles, and always think long-term. Alright, that's it for today's video. If you found this helpful, don't forget to give it a thumbs up, it really helps the channel. And of course, make sure to subscribe and turn on the notification bell so you won't miss my upcoming insights on the markets and investment strategies. I'd also love to hear your thoughts. Where do you think the market is headed next? Share your ideas in the comment, let's learn and grow together. Thanks so much for watching, and I'll see you in the next one.